G'day and thank you for joining us for the Firetrail quarterly update. This update we're going to focus on the quarter that's just been, but also the financial year, and with us we've got Blake Henricks. Blake, thanks for joining us.
Thanks, Kyle.
Blake, it's been a really dynamic market for investors, and there's been some key challenges and shifts that we've seen. What are you seeing on the ground?
Yeah, we've had a very, very busy travel schedule in recent times. I was up in China, we had Scott in the UK, we had James in the US, just in very recent periods. So on the ground, I think what we are seeing is weakness and low confidence from company corporates we talk to. The trade wars are weighing on sentiment. That's delaying capital projects. It's also delaying hiring. The shaking of hands at G20 was a good start, but I think many are a bit more sceptical than that. So, overall, I'd say conditions are a bit softer. In the UK, we've been going there quite a bit recently, and the UK economy was holding up really well around Brexit when everyone thought it'd be very weak. I think what we've seen in the past quarter is that actually it's weakening a bit. And then if I think about in the US, things are okay. Unemployment remains low, confidence is low, yes, but things are actually ticking along okay in the US.
Excellent. And bringing that back home here domestically, what have you been seeing domestically over the past 6 months?
Yeah, in the June 19 half, the consumer, I'd call it in a recession. The trading feedback from companies we speak to and also what's been announced has been very, very weak. We saw Flight Centre downgrade, Star, 90B, there's a whole list of companies who've downgraded in the June half, pointing to a very weak consumer. But there's been a lot of firepower and positive news for the consumer in recent periods. RBA's cut twice, 50 basis points, of which around 40 to 45 basis points have been passed on by the banks, so rate cuts. We've seen negative gearing and franking credit reform taken off the table through a Liberal victory. We've seen tax cuts now going through to the consumer, and you've also seen APRA releasing some of the pressure that's been on lending standards. So there's been a whole lot of firepower put onto the consumer. The big question is, how is it going to react? Our working view at the moment is that we're going to see a stabilisation. We do think we've seen the bottom in East Coast house prices, which have been under the pump. But I think it's a bit too early to get really excited, because if you look at, say, the tax cuts and the checks people are going to receive, it's around $1,000 for low to middle income earners. It's around 10 to 20% of what happened in the GFC, which caused a big spike in retail. So we don't think you're going to see that, but certainly a stabilisation in the Australian consumer is on the cards.
That's great, Blake. And I suppose keeping that focus on opportunities, one question we are getting from a lot of our clients is where we're seeing opportunities in this sort of market environment. So how are you positioning the portfolio, and where are you seeing those stock-specific opportunities?
Yeah, there's two main areas. I'd say one is boring is beautiful. A company like Woolworths, many people see it as sleepy. Some in the market see it still as a very, very competitive space. And it is a competitive space, but if you actually look at the competitive intensity compared to the last 5 to 10 years, it's, we think, at a nadir. You've got Coles who've been spun out on their own, having to spend money on CapEx and dividends. You've got Aldi who's struggling to get that really great sales growth they've achieved over the last 10 years. And you've got Woolworths in there as well. So Coughlin is going to enter at some point, potentially Amazon. But right now, what we're seeing is that the supermarket space is very, very attractive. Overlaying that in Woolworths, you're seeing it's being shaken up. They sold their petrol station business to Euro Garages for a good price and did an off-market buyback. And then just recently they announced they're going to spin off their ALH, which is the hotels and pubs, combined with BWS and Dan Murphy's in Endeavour Drinks. Those three businesses are going to merge, and then be demerged next year. So, Woolworths is being very active, and they want to reinvest and focus more on the supermarket business, about being good in digital and being good for customers. Another boring is beautiful would be Telstra. We've entered that position this year. We've been in mobile competition very aggressively as TPG entered the market with their own mobile network plans. There's been a reversal of that. TPG and Vodafone are trying to merge. ACCC's blocked it. That's now going to be in court at least until the end of this year, more likely into next year. So that's caused a bit of a pullback in some of the plans that Vodafone and TPG had on the mobile side. And at the same time, Optus, who's been very, very focused on market share for the past few years, has changed their tune. They need to get their return on invested capital up. And it's been in decline for the last few years. So the mobile space has become less competitive, and I think that'll be good for shareholder returns over the next couple of years. The other side of the ledger, apart from boring is beautiful, is on the cyclical side. So we still see a lot of value in Worley Parsons, New Farm. We've talked about those extensively over the past little while. But another one would be Qantas. We've been increasing our position. On the surface, you're seeing weaker potential demand in leisure and also potentially in corporate. But airlines have always been about supply and demand. And so yes, demand is weak, but we think that's the supply side is being very, very rational. You've still got Virgin who are losing money. They need to get their profits up. And so while the market's view is, well, Qantas has gone from $1 to $5.50, it must be expensive, we actually still are not seeing a competitive equilibrium where everyone's making money. And so, you know, Qantas with its demand overhangs is creating the opportunity. The supply side is very, very rational at the moment. Globally, it's one of the cheapest airlines, and we think this is going to be a really good period for Qantas compared to expectations.
And just touching on that differentiation and how we approach positioning and performance, obviously taking a different view to the market over the past 12 months has resulted in underperformance. Can you comment on the performance for the strategy over the last 12 months?
It's been incredibly disappointing. There's no other way to talk about it than that. There's really been four main detractors to performance: Worley Parsons, New Farm and Clydesdale, all of which we still have conviction in. You know, we still think by being patient, we're going to see some really good shareholder returns over time. One that we did get wrong, in our view, is Reliance. We've exited that position in recent times, and the reason is it's not a bad business, but we were expecting a lot of growth from the company. They have been delivering that, but we think now it's in a bit more of a mature phase than we'd expected. And you know, while the valuation looks undemanding, we do think the growth expectations are a little bit too high.
So Blake, what can investors expect from the strategy over the medium to long term looking forward?
Sticking to the process. I mean, that's what has built a long-term track record in the strategy. It's been a very tough year, but you know, we're always looking forward, remaining as rational as we can be, and that's how you make money over time. You don't make money by panicking. You don't make money by trying to follow the next big thing. It's by doing the research, sticking to the process, sticking to the philosophy, and that's absolutely what we're focused on.
Excellent. Blake, thank you for your time, and thank you for tuning in to our latest quarterly update video.
Thanks.